I know you're all excited for it, and in this video we're going to be talking about the land tax changes here in Queensland. This has been a requested video in the comment section, so if you've got any other topics you'd like me to talk about, make sure you drop a comment down below and I'll be sure to read them. I respond to almost all the comments I receive on the YouTube channel, and maybe I'll be talking about a topic that you want to hear in a future video. But in this video, we're going to be breaking down interstate properties and land tax in Queensland and the changes that have been made by the government. You can see on screen here that from 30th of June 2023, when the Queensland government calculates land tax, they're going to use the total value of your Australian land for the calculations. Now, this is a controversial topic because why would you be paying land tax on all of your Australian property when it's a state-based tax? This has got some investors up in arms, but we're going to break down examples of what this might mean in your property investing portfolio and exactly how you might be able to manage and minimize the land tax over time by structuring yourself in the right way and buying between personal names and company and trust structures. I'm going to break all of that down, so make sure you stick around to the end where I give you real and practical examples of how to manage this over the long term. So this includes your taxable land in Queensland and your relevant interstate land. The total value of your Australian land will be used to determine whether the tax-free threshold has been exceeded and the rate of land tax that will be applied to the Queensland proportion of the value of your land holdings. The current tax-free thresholds in Queensland are $600,000 for individuals and $350,000 for companies, trustees and absentees. You'll only pay tax on the land you own in Queensland, i.e. we are not taxing your land outside of Queensland. So if you had $500,000 of land in Queensland that was below the threshold, but now you're being assessed on your Australian land, so you have $1 million in New South Wales and $500,000 in Queensland, that's $1.5 million across Australia. The Queensland government is now going to assess your rate based on the $1.5 million and then ratio it for the $500,000 that you've got in Queensland. So even though they're saying you'll only pay tax on the land you own in Queensland, the way they're assessing it is based on your Australian land. And so you would have been below the land tax threshold originally, if that was in your personal name, and now you'll be paying land tax in a situation that you wouldn't have previously. Now let's break that down with some real numbers and an example here on screen. This was provided by the Queensland government. So prior to the changes, an individual landholder with $600,000 in taxable land in Queensland and $400,000 in New South Wales would pay $500 in land tax in Queensland, which is 0.0834% of their land value, and no land tax in New South Wales at the current thresholds. Under the new system, the same individual landholder with $600,000 in Queensland, $400,000 in New South Wales would pay $2,700 land tax in Queensland, even though their land holdings in New South Wales is below the New South Wales land tax free threshold, and him or her is not subject to land tax in New South Wales. So basically what Queensland is saying is you own land across Australia, you're going to be paying more land tax in Queensland because of it. Now this article also talks about some practical difficulties. So real properties have been governed under state-based jurisdictions. The Office of State Revenue will need to obtain and merge data from other interstate land registries to put this information together and to actually inform these calculations. There's a lack of uniform land tax rules across Australia, and arguably in circumstances where an individual owns taxable land in other states that are subjected to land tax already, they will be penalised for their Queensland land holdings at a higher rate. And that is the truth of it at the end of the day. The Queensland government is essentially penalising people for owning properties in other states, and the result is you're going to have to pay a higher rate on your land tax than you would have otherwise previously had to pay. So in the example previously given above, you would have been paying $500 per year in land tax. And under the new system, you're going to be paying $2,700. Now, if you have a couple of properties and you hadn't budgeted for this and you weren't aware of how these changes were going to affect you, then you could be having a bill that adds up to tens of thousands of dollars. So that's the scenario that we're in. That breaks down where we were and where we're heading in terms of the new land tax assessments that are going to be placed here in Queensland. So what does this mean for you, and how can you structure yourself in a way that's going to be efficient in terms of avoiding and minimizing land tax? Legally avoiding, of course. Now, for your current property portfolio, it's going to be very difficult for you to make changes to your current structures. So let's say you've got $1 million of land in Queensland that's going to be assessed and $1 million in New South Wales, split across a couple of properties. At the end of the day, if you've bought all those properties in personal names already, it's going to be a significant cost for you to change over the structures that are owning each of those properties to try and minimize your land tax bill. Now, land tax is assessed at the owner level. So if you own the property in your personal name, or if you own it in a separate company, which for accounting purposes is essentially a separate legal entity, you're going to be assessed at the individual level or at that company level or at a different company's level. So if you have multiple companies and your personal name, you'll get different thresholds for each of those entities. Like I said earlier, the individual threshold in Queensland under personal names is 600,000. For companies and trustees and trusts, it's 350,000. So if you're already locked into certain structures, then it's going to be costly to pay that stamp duty to change the structures that you have at the moment. But going forward, to mitigate land tax, I would look at having investment properties in separate structures. This does get a little bit more complicated, but most people are going to be starting off in buying in their personal names, which is the most simplified approach. And once you're looking to hit those land tax thresholds in Queensland, in New South Wales, that's when it's likely going to make sense for you to have a chat to an accountant, have a chat to a trusted advisor, and then look at potentially buying in structures. The thing with structures is that they do cost a few $1,000s for you to set up and maybe $1,000 every year for you to maintain. So you might be looking at $3,000 or $4,000 to set up your company and your trust structure. And then you're going to be paying, say, $500 a year or $1,000 a year to do your income tax returns for your company and your trust. But for people who have hit their threshold in personal names and are looking for ways to minimize their land tax, then using separate structures is going to be the best way to move forward. That's exactly what Emily and I are looking to do over the long term, buying properties with land value less than $350,000 in a company and a trust structure here in Queensland, because the company will be assessed at its own threshold. There are aggregation rules here in Queensland where Queensland government will look at your position and look at the structures and try and group you, but have a chat to your accountant, get an understanding of personal names and company and trust structures. Use the company as that corporate trustee above a discretionary trust, and you'll be well on your way into managing a property portfolio through those company and trust structures. At the end of the day, we're not looking for tax evasion, we're looking for tax minimization. We want to play well within the bounds of the government and the rules are always changing. That's why it's important to keep up to date with what's going on in your relevant state and across Australia, and we need to adapt over time. I've definitely had a planned strategy around our portfolio for investing over the long term and how we're going to use structures and potentially gift properties to our children down the track through these companies and trust structures. So look at your planning both in the short and the long term and how you might be able to minimize land tax by setting yourself up between personal names and company and trust structures. If you got any value out of this video, make sure you drop a like down below, subscribe to the channel, head over to purposeproperty.com.au if you're looking for a Brisbane-based buyer's agent. Otherwise, click this video over here for more things real estate, renovating, and financial freedom. I'll see you in the next one. Peace.